Good evening and welcome to tonight's economic briefing, where we take a closer look at a question that keeps surfacing behind closed doors in research departments and high-level strategy calls: what comes next for global markets? If you've been watching quietly from the sidelines, sensing that the calm feels artificial, you're not alone. Analysts, central bankers, and institutional investors may disagree on timing, but many now whisper the same unsettling idea: the clock is ticking, and those ticks are getting louder. Some call it coincidence. Others call it the cycle. But as we break down the patterns, one thing becomes increasingly difficult to ignore. Several converging forces hint that the window between mid-2026 and late 2027 may not pass quietly. And yes, if these indicators hold, you may have 18 months before pressure turns into consequence. Look at the rhythm of economic cycles. Major imbalances rarely explode without warning. They build silently in the background. Corporate debt maturities begin to cluster in 2026, a delayed consequence of record borrowing at artificially low rates back in the early 2020s. That debt must be rolled over, but now at far higher costs. At the same time, central banks remain stuck between controlling inflation and protecting growth. If they cut too early, they reignite inflation. If they hold rates too long, they choke off credit. Investors are asking which choice is worse, but history suggests markets react violently when funding stress and high leverage meet in the middle. The unsettling question becomes: how long can strained balance sheets carry the burden of yesterday's cheap money in the world of tomorrow's expensive capital? Meanwhile, geopolitical uncertainty refuses to step aside. Energy dependencies, supply chain relocalization, and persistent regional conflicts continue to push input costs higher. Markets may shrug at headlines today, but it is often not the event itself that shakes investors, it's the accumulation. Think of 2000, 2008, 2020. Each crash appeared sudden to the public, but anyone watching the pressure points saw the thickening cracks long before the break. Today, those cracks show up in declining savings rates, rising consumer credit reliance, and businesses quietly delaying hiring or investment plans. The surface may still look smooth, but the water beneath is churning. Here's the hook many overlook: liquidity evaporates fastest right before a downturn. When credit tightens, asset prices don't fall gently, they fall all at once, because everyone reaches for the exit at the same moment. As we move closer to 2026, even a mild slowdown could pivot into something sharper if confidence slips. And confidence is a strange creature. It grows slowly, but when it breaks in an instant. I'll leave you with this: markets don't crash because people expect them to. Markets crash because too many assume they never will. The next 18 months won't determine everything, but they could determine how prepared or how exposed you are when the next cycle arrives. Stay observant, stay analytical, and above all, stay aware that history rarely repeats perfectly, but it often rhymes loudly enough for those willing to listen. The clock is already ticking, and the most overlooked fuse in the financial system is not in the stock charts, not in central bank speeches, but in corporate balance sheets that are quietly approaching their moment of reckoning. Between mid-2026 and late 2027, nearly $1 trillion in U.S. corporate debt, issued at historically low rates during the pandemic stimulus era, will come due. Investors and executives once celebrated those cheap loans as lifelines, but those same obligations are now transforming into economic landmines. When corporations rolled over debt at 2% or 3% interest, profitability looks secure, yet today, refinancing means facing rates 3 to 4 times higher. Imagine a company that once paid $200 million annually in interest suddenly paying $600 or $800 million, without any guarantee of rising revenue. Margins contract, investment freezes, layoffs appear not as strategic decisions but as survival instincts. And the most striking part: this rollover shock is not a fringe concern, it is systemic, synchronized, and unavoidable. Many ask, why would this trigger a market crash? Because refinancing is not optional. Debt maturity is a fixed deadline. Companies cannot negotiate with time. Every month from mid-2026 onward, a growing number of firms will face that moment of truth, and their ability to absorb higher borrowing costs determines whether they shrink, default, or offload assets at distressed prices. Investors may currently dismiss the threat, pointing to strong earnings or resilient consumer spending. But those indicators reflect a world where past debt terms still apply. The shock arrives when yesterday's cheap money becomes tomorrow's expensive lifeline. When capital becomes costly, growth becomes fragile, and the market's tolerance for disappointment collapses faster than most analysts care to admit. The hook most people miss is the domino effect. If even a small percentage of large firms buckle under refinancing pressure, credit spreads widen, junk bond yields spike, and banks tighten lending, not out of caution but necessity. Private equity funds that relied on leverage for acquisitions suddenly face higher interest costs that crush returns. Commercial real estate, already weakened, struggles to refinance towers and shopping centers as institutional capital grows risk-averse. In this environment, confidence doesn't decline gradually, it evaporates suddenly. The same investors who cheered aggressive growth strategies during the era of zero interest money scramble for safety as defaults rise and liquidity thins. What looks like a corporate debt issue today could easily become an equity market crisis tomorrow. And here is the uncomfortable truth. Everyone is watching inflation, rates, elections, and geopolitical tensions, but the real catalyst is hiding in plain sight. Corporate America borrowed its future when money was cheap, and now the bill is coming due. The question is not whether pressure builds, it already has. The real question is who can survive in a world where debt is no longer an opportunity, but a weight pulling markets closer to the edge. Consumer strength is often treated as the market's safety net, yet beneath the surface the American household is stretched thinner than it appears, and that tension becomes critical when markets approach their breaking point. The story begins with purchasing power, because while wages have risen, inflation has risen faster over the past several years. The average worker feels richer only on paper, at the grocery store, at the gas pump, in rent payments. Reality tells a different story. When necessities consume a greater share of income, discretionary spending shrinks. And that contraction is precisely what drives downturns from mild slowdowns into deep recessions. When households are forced to choose between paying bills and maintaining lifestyle consumption, corporate revenue models crack. Companies dependent on consumer demand, from retail giants to tech platforms, face slower growth, tighter margins, and eventually weaker stock performance. It is not the dramatic events that break markets first. It is the gradual erosion of spending power that silently removes the foundation beneath corporate earnings. The hook few people recognize is that consumers are already compensating for lost purchasing power with something dangerous: debt. Credit card balances in the United States have surpassed all previous records. Delinquencies are rising in age groups that historically managed debt well and buy, now pay later services mask spending strain while delaying an unavoidable reckoning. Household savings, boosted temporarily during pandemic stimulus, have been depleted in many cases. Americans are spending tomorrow's income to maintain yesterday's lifestyle. This behavior may hold consumption steady for months, even years, but when the bill arrives, and it always does, spending must contract sharply. If this tightening aligns with the corporate refinancing pressure already building, the economy does not experience a soft landing. It confronts simultaneous demand weakening and cost escalation. The emotional impact comes in a question that few want to ask, but many are silently thinking. What happens when consumers stop pretending they can afford the present? The answer is unsettling. Falling retail sales pressure companies to cut prices, but higher financing costs prevent them from doing so profitably. Layoffs begin not merely as efficiency measures, but as existential decisions. Rising unemployment then feeds back into weaker spending, triggering the kind of cycle that historically precedes market crashes, not through panic selling at first, but through declining earnings that force valuations downward. Asset managers ultimately adjust expectations, algorithms react, momentum reverses, and only then does the public realize the shift was underway long before headlines appeared. What makes this moment different from past cycles is timing. Households are strained before a downturn has officially begun, meaning consumers will have less resilience when the shock hits. The middle class is no longer the stabilizer, it is the barometer. When its spending falters, markets follow. The stage is set, the pressure is building, and the true test is not whether the consumer can keep spending, it's how long they can continue spending on borrowed time. The market today feels deceptively calm. Yet beneath that surface lies a structural imbalance, waiting for the slightest catalyst to turn unease into acceleration. Central banks have raised interest rates to combat inflation, but they have not fully reversed the decade-long era of ultra-cheap money that inflated asset prices across stocks, bonds, and real estate. What we are witnessing is valuation compression in slow motion. Companies are still priced according to a world where borrowing was free, liquidity was abundant, and risk felt theoretical. But that world is gone, replaced by an environment where capital has a cost again, and profitability must justify itself without the crutch of endless leverage. The hook is simple: markets have not yet priced reality, only the memory of the past. And when that pricing shift finally hits, it won't be gentle. Investors often underestimate how sentiment shifts from subtle to sudden. For years, markets rewarded growth stories, even loss-making firms, because low interest rates made future profits look more valuable. But now, the discounting of those future profits is harsher, meaning companies must deliver more today to justify their valuations tomorrow. When revenue weakens, when margins compress, when debt rolls over at higher rates, the equation becomes unsustainable. Institutional investors know this, which is why money is quietly rotating towards safer assets. The average retail investor still believes the market can climb indefinitely. But professional capital senses the imbalance like a pressure change before a storm. The danger comes when the crowd notices too late and rushes for the exit simultaneously. Here's the hook: almost nobody sees coming. The current calm is the setup, not the conclusion. Every major crash in history was preceded by a period of quiet confidence: 1929, 1987, 2000, 2008. Markets didn't fall because conditions were bad. They fell because expectations were too high for the reality beneath them. Today's valuations still rest on narratives built during zero-rate euphoria, AI hype, tech dominance, consumer resilience. But narratives cannot pay interest costs, cannot stop earnings declines, cannot reverse the gravity of higher financing expenses. When expectations break, prices follow, not gradually, but with the kind of speed that leaves investors stunned and searching for explanations that were visible all along. This imbalance becomes most dangerous when external shocks collide with stretched valuations. A geopolitical escalation, a credit event, a major bankruptcy, or even a disappointing earnings season could flip sentiment overnight. Once confidence cracks, selling feeds selling, risk models trigger automatic de-leveraging, and liquidity drains just as demand to exit surges. Markets don't fall when everyone is afraid, they fall when everyone still believes things are fine. And right now, belief is the last support holding valuations aloft. The moment reality replaces belief, the slow drift becomes a sharp drop, and the imbalance that was ignored becomes the force that defines the next market cycle. A warning sign has been flashing for years, yet few want to stare directly at it. The asset bubble in commercial real estate and private equity is no longer quietly inflating, it's quietly leaking. And these cracks matter because they sit at the core of the financial system that feeds credit, supports jobs, and shapes market confidence. Office towers in major cities remain half empty as remote work reshapes demand, while refinancing deadlines approach with interest rates triple what they were when properties were acquired. The math that once worked no longer works. When a building purchased with optimistic forecasts now generates only half the revenue needed to cover debt service, owners face a grim choice: default, sell at a loss, or beg lenders for extensions. None of these outcomes stabilize markets. Here's the hook: commercial real estate is not just property, it is collateral. When collateral weakens, lending weakens, and when lending weakens, the economic engine slows. Private equity faces a parallel strain. For a decade, these firms thrived by buying companies with borrowed money, cutting costs, and selling them at higher valuations, supported by cheap financing. Today, the same firms confront higher borrowing costs, falling consumer spending, and exit environments where valuations are weaker. The strategy that once printed billions in returns now traps capital in portfolio companies that cannot sell or list without crystallizing losses. Investors who expected liquidity faced delays, and delayed liquidity means pressure to restructure, pressure to raise additional funds, pressure that eventually ripples into banks and pension funds exposed to these assets. When major institutional investors feel strain, the effects are not contained. They spread through the financial system like stress fractures, unseen until a sudden break. The part almost nobody notices is how these vulnerabilities link directly to market instability. When commercial real estate borrowers can't refinance, banks tighten lending standards. When private equity firms can't exit deals, they reduce new acquisitions. Less lending and fewer acquisitions translate into fewer jobs, weaker growth, and lower demand for goods and services. Corporate revenue declines, earnings disappoint, and market expectations adjust downward. The story does not start in the stock market, but it ends there, because stocks are reflections of economic activity, not its cause. When the underlying activity slows, such reflections darken. But here comes the hook that should make every market participant pause. These sectors do not implode loudly, they decay quietly. Defaults appear building by building, company by company, fund by fund. Headlines rarely show a dramatic collapse until suddenly they do. All the while, balance sheet deterioration accumulates like hidden weight on a structure designed for lighter loads. Markets rarely crash because of one big event. They crash because a collection of pressures finally becomes too heavy for belief to hold up. The fragility is not hypothetical, it is present, quantifiable, and recognized privately by those closest to the data. The question is not whether these strains exist, they do. The question is how long markets can ignore them before the weakening foundation beneath asset prices becomes impossible to overlook. When investors finally connect the dots, sentiment won't shift gradually, it will snap. And once confidence snaps, the decline does not unwind the future. It unwinds the assumptions of the past. Thank you for joining us tonight. Until next time, keep watching the signs that others ignore, because sometimes what sounds like noise is actually the warning before the impact. Stay informed, stay grounded, and we'll meet again with more insights as the timeline unfolds step by step.